Ira Epstein of Linn Associates with your metals market wrap-up for this Monday, and we're at September 28th, 2020, just getting on to 5:40 p.m. Central Time. So in the metals, we had an up day. The market's come away from that 1850, 60 level that it's been playing with. Popped back up. Silver's looking real good since it's hit its 100-day moving average a week ago, and it's really added to the value there. So then the question is, what are we doing and why are we up? You know, tomorrow's the presidential debate. I think that's going to be a big number. End of the week, we get jobs data. You got to be looking at that as well. Other than that, well, we keep looking at the COVID situation. We're seeing so many areas trying to get something back to normalcy. I know in Chicago, they said they're changing the restaurant rules, so we get back to, instead of 25%, maybe we're 50% capacity. Winter's coming. It's cold out there right now, so we'll see what goes on. You know, and I'm talking winter because we all know it's, 6-7 weeks away, longer than that sometimes, but the coolness is here. And you can't really sit outside when it's 50 degrees at night. It's very difficult if you don't have heaters and ways to do that. When we look at the gold market, I'm not surprised to see on a weekly chart of just closes. So the moving average on just closes is going to be different a little bit than other parts of the market, but it's only closes. And the market got down, challenging that number, 1865.90. When you go to a daily bar chart, you see where you're at. You see the swing line has changed. So for the first time, what the market did with the rally that took place today, this is how we looked coming in on Friday. And with the rally now that we just put in place, we had an outside day up. We're getting a little follow through tonight, but that means we have higher lows and higher highs. We've broken the pattern of lower highs, lower lows, put in a bullish pattern unless you step back and you take out today's low of 1851.10. That moving average, well, the moving average of December gold closes is 1927.30. So you'll say, why are they different from the other? The other is a continuation chart of just closing prices. This is just the December contract. So that's the difference. The market is fighting a battle where I told you. A lot of traders like to step in and look at main moving averages. 100-day could be one, a 200-day could be considered a main. And those are numbers they want to load up on if they're on the bull side of the market and if the market's falling down to them. It all depends where these averages are. I think the bulls took a stand there, and I think they'll have a problem at 1927.30, the 18-day average of closes. I think that the combination of the lower Bollinger Band and the 100-day gave traders that confidence for whatever reason. They know the Fed wants to let inflation loose if they can get it going. That's been the problem, getting it going. So when you look at this chart now, you're under the 18-day moving average of closes, which means bias is down, but the swing line is up. So the two fight each other. You don't have much of anything going there, and you have an oversold condition. Basically, as I read the chart, the bear raid on the market came to an end. You haven't begun anything bullish yet on the daily chart. In the gold-silver ratio, was this enough? The market is starting to ease back, got up as high as near the 80 level on the differential, which means you had gone from needing only 70 ounces of silver at this point to needing about 80 to get 1 ounce of gold. And that obviously was more bearish for the silver than the gold because you need more silver to do that. And silver has not changed its overall bearish pattern. It still has lower highs, lower lows, very similar to gold, did the same thing. When the market got down to the 100-day average, I was very clear here and I said, I think that you're going to see the longer-term traders start stepping in. One of the ways they do it in futures, use those smaller contracts, that macro mini. We charge $1 a side to trade. Come on, it's not too bad on the commission for that. And as you can see, you're trying to turn momentum up. There's plenty of resistance above the market at 25.78 thereabout. And there's support if you fall back again between 22.18, the 100-day average, and the lower Bollinger Band at 22.32. But the bears are still in control of this chart. In the copper market, as we fell down and got close to this 290 level, you got to 291.35. I thought the market was a little overdone. It proved to be. It got right back inside the Bollinger Bands, and they've been rallying. But do we have a trend? We don't. You really have a higher high, lower low. That isn't the trend. I wouldn't be surprised if you get up in that 303 area where the 18-day average is and just sort of hang around there. It doesn't have to even go that high. You're not trending on this market. In the platinum market, you've had a pattern of lower highs, lower lows. Now let me show you. Let's take off today's action. The last rally high was right here. And that number, just so we can see it, is 901.10. The market then continues its plunge. You know that I will be telling you, when you get under a Bollinger Band, you're getting a bit excessive. And now you're trying to get a rally going with today's rally at 896 stalling, right at the 100-day average. Now, do I think the bears are going to get real aggressive here? I doubt it. And the reason is you have an oversold market that's not trying to embed. I think the market is now one where you're getting your bounce away from that number, and you're not going to get that, what we call, at least I term that gorilla glue trade, where you just keep leaning on the Bollinger Band. You got away from it on Friday. You see that? And now with this other thrust, you're not going to embed. Nah, I wouldn't be surprised if the downtrend has paused itself. To tell me it's over, you got to get over that 901.10 area. In the palladium market, it's more similar to what you're seeing in the gold market. Now you've got higher lows, higher highs. So you're out of the downtrend, and without today's action, you had lower highs, lower lows, right into the Bollinger Band. Do I ever say sell a Bollinger Band? Never. And oversold. Now, I wouldn't have touched that. So to get up here, yeah, you can get back to the 2310 level and fight a battle. You'd have to close over 2310 to get bullish. So that's the number you look at. You look at this number as being the resistance point, but a close over it would give you the swing line up, the bias up. Maybe momentum would then turn with the market. Right now you have the bias down, the swing line up, the two fight each other, you have nothing, in an oversold market that might be ready to turn up, we don't know yet. Last in the dollar index, we had been looking at this upper Bollinger Band as a number that the market was fighting at. It is still doing so. It's still an embedded reading. Embedded means that the two numbers that make up the slow stochastic were overbought, going sideways over the 80 level. But after you do it several days or more, in which this market has done, you can see that right here, that becomes embedded. So when the market loses that, it loses it by the red line when it's going to turn down, closing under 80. Until it does so, pokes to the downside are generally well bought by the pros, but they will, just like that, throw them out if you lose the embedded reading. At least that's what I teach on my chart. Can you lose the reading and get it back the day after you lose it? It's the only time you can do it. Otherwise, it's got to go through the whole rebuilding process. So this, to me, is not yet a sign that the dollar's through on the upside. It's a warning, but no more than that. And pulling back in it, no, I don't think you've scared off the longs just yet at all. I talk about all these things with you, and I try to really drill them in. But the way you learn it is taking my charting course. And on the charting course, it's all video. So you get 6 hours of video. You're going to learn via first a PowerPoint video that I create. Then you see the actual way that you're supposed to apply it on a chart. Then I teach you all about it. You're going to learn the secrets I have of the Bollinger Bands, the slow stochastics. You're going to be able to look at a chart, throw the name of the chart off. I don't even want you at the end of the day, and that's how I teach in the video. I take the name of charts off, then I bring them back. I don't want you to know if you're looking at a stock, a futures, a spider. Who cares? A chart is a chart. And you're trading the pattern. You are not trading the fundamentals. You are trading the pattern. And I have rules for the fundamentals. Why would I go through a Fed fund report? I'm certainly not going to. I don't know how much I want to go through tomorrow's presidential debate. I'll make up my mind tomorrow. But in looking at all this, I teach it. And it's not expensive. Included is free access to my research for 30 days if you're not currently getting it. Access to our charting software, a $100 value by itself. My research is $60 a month, so that's $160. The whole course is $199.95. Interested? Go to our website under the word education. It explains it all there. I'm Ira Epstein. You have a great day. I will see you all tomorrow. Take care.